We're getting to the fun stuff and making money work for you. This is what it's all been about. Let's start with answering the question of where to save your money. Now, most people do this in banks, where they save their money, but they look at it the wrong way. So look, banks, they're not just storing your money safely, but they're using it to lend to house buyers, to those who wish to start businesses, and to those who want to finance things like cars or even companies, right? So they charge those borrowers a lot more than they pay you as a saver. And the interest rate difference between what they charge borrowers and what they pay savers is called the net interest spread. Or you could think of this loosely as the bank profit, at least before their operating costs, credit losses when they don't get their loans repaid, etc. Now, the loan rates that the borrower pays could be 7%, but the saving rate that you as the saver get may only be 1%. So the bank takes the difference of 6% as its gross profit. Now, it's important to shop around for bank rates, else you're just handing extra profit to banks for free. So you should keep as much as you can. Compare rates. Now, I personally love bankrate.com. Use independent sites like that, not your current bank's marketing page, because they're trying to sell you on their bank. And think of what you need. Now, you may want access to your money at any time. This is called liquidity. Savings or online savings like high yield savings. Here, we're thinking about app transfers. There's no real checkbook. But you could use money market deposit accounts. There you do have an ATM, right? Teller machine you can write checks, insured, just like the online high yield savings. There's also money market funds. Now, this takes a bit longer, usually 1 or 2 days, not too long, but they're not insured, right? That's not insured. Now, if you're happy locking away your money for a little while, then think about things like certificates of deposits or CDs, or what sometimes is called savings bonds or notice accounts in some other countries. Now, honestly, I've found in the US at least, high yield savings that are quite liquid. These beat CDs, right, or certificates of deposit, or at least they pretty much match them. And if there's any difference, it's usually tiny. So what's the point in keeping it there for 6 months or a few years in a CD? Now, in some countries, you have things called notice accounts. They sometimes require, things like 60 or 90 days notice. CDs or certificates of deposits, they're typically things like 3 months all the way to 5 years. The most popular tend to be around about 12 months to 24 months. That's about a 1 or 2 year. Now, CDs, they just may not be right for your emergency fund if you need the money, right? If you need rapid access. But I think it's still fine, as you just lose the interest if you pull out early. Another thing to consider is a thing called government Series I savings bond. You can get these from treasurydirect.com. They let you buy up to $10,000 per person per calendar year, but also up to an extra $5,000 more if you get it through a federal tax refund. You must hold them, though, at least 12 months. And if you cash out within the first 5 years, you forfeit the last 3 months of interest. Now, after 5 years, there's no penalty. So if your spending is, let's say, 1 to 2 years out, even up to 5 years, you might want to consider Treasury or T-bills. They're usually 4 to 52 week maturities, and you can buy them again through treasurydirect.gov. You can buy them also through brokerages or even some online banks, and even ladder them, so stagger them out. So if you need something, let's say, buy it every 4 weeks. If you want to keep buying 4 weeks things like that, or buy like a 52-week thing every month or so, that way it's going to be due. The next one's going to be due. 52 weeks, buy another one a month later, so that one becomes due the next month. So that way you're not waiting all 52 weeks, right, for each one. So staggering or laddering is one little thing above and beyond this video, but consider staggering, looking into laddering if you're interested in doing that. I personally don't do that. I find that it's easy just to use online savings. You get a pretty good return, pretty good rates, everything. The tax differential is very, very slight. And by the way, if if you're watching this and you're not an American person, you're not living in America, etc., you're living somewhere else, you're out of the system, consider interactive brokers for access. By the way, you can't get the actual Series I government bonds, but there are other things you can get into. You can get into things like the T-bills, in particular Treasury Bills. That would be kind of the way to go if you were living abroad. There are other things you can do, but if you are living abroad, or you're in Europe, European watching this, or somewhere else, it might be worth a looking into high yield savings money market deposit accounts or treasury money market funds that now offer competitive yields. It's not just traditional banks, but online banks and even investment platforms are increasingly offering these competitive cash accounts. Now, I don't like saying specific interest rates because this video would age really badly, right? Even before this video is finished, the rates will change. Now, European traditional banks, the rates there are painfully low. European high street rates are still pretty thin, but marketplaces and neobanks, they've shaken things up. An example would be like, Raisin for shopping insured deposits across the European Union banks. There's also Revolut and N26 or Bunk for insured in-app savings. There's also Trade Republic or Scalable for interest on cash balances. So if you're comfortable with money market funds, then Wise Interest is another route. Not a bank deposit, so protection differs and you should check which deposit guarantee applies, the country, any fees or tiers, and also just note that the rates are variable, they can change. Newer platforms offer attractive returns rather than just lower, boring returns, as they've got much fewer overheads. These online banks, they're not brick and mortar, unlike the traditional banks, right? So they can pass more of their profit margin onto you as a customer. Like you walk into a main high street bank, your Bank of America's, your Wells Fargo's, etc., and it looks beautiful, and you got all the nice brickwork, and they got all the nice places, and this is nice. Yeah, how are they doing that? They're making profit, a lot of profit, right? So the online banks, they're not spending on bricks and mortar and nice foyers and nice receptions, right? So they can pass a lot more of the profit margin onto you, the client, you, the consumer, you, the customer.